In the fast-paced world of business, finding a clear path to profitability can be a challenge. Welcome to 0 to 100 with your host, Jared Guy Randolph, seasoned business and finance expert. Tune in for actionable insights and strategies to accelerate your business success.
Hello, Accelerators. Welcome to another episode of 0 to 100. And today's guest, financial advisor, Reese Stiller of Kingdom Guard Financial Group, is going to shed some light on how you should be managing your finances. What I really like about Reese is that he goes beyond the numbers to help his clients build an actual business. And some of the topics that we are going to cover is the difference between having a true financial plan and just having accounts, balancing your personal and your professional finances separately, and something that I think the audience really needs to hear because it was a unique perspective that I sometimes forget myself as a business owner, and it is that you are not the business. For those of you who do not know me, my name is Jared Guy Randolph. I am the founder of BoxFi. We are the nation's leading payment consultant, providing business growth solutions through payment processing. And I am very excited to share the network that I have built over my 25-year entrepreneurial journey to help you grow your business and become more profitable. Ladies and gentlemen, let's accelerate together. Reese, it is great to have you on 0 to 100.
Hey, thanks for having me, Jared.
Awesome. So before we dive in, we have a new way of starting each episode, and we ask our guest if they have a motto or a quote or something they always find saying to their clients when they're doing business with them. What is yours?
Ours is see the difference.
So walk me through what see the difference means.
Yeah, so in general, it's just the aspect of how our overall service model comes in. It's just naturally it just came to we were always repeating well, that's the difference here, or here's the difference here, or here's versus things that they always experience. We're like, you know what, we are different. And so see the difference is what we've really figured out is our main, slogan, motto, whatever you want to call it, for a multitude of reasons between the service levels we provide, our faith-based backgrounds in the financial services industry, which is usually pretty rare to come across, how we conduct ourselves overall, our service options themselves. That's why we've just coined see the difference. And that kind of came up from the start as we were just working with various people and clients. We're like, this is a repetitive statement.
Well, you know, it's interesting that you say faith-based because, I always say on the podcast, we don't talk politics or religion in terms of the world is this way because of politics or religion, but I always welcome the conversation around anyone's business that is based on their faith or their belief. And what is actually cool that I just learned is one of my dear friends who's well-respected in the family office and wealth management arena, and actually has a theology degree. Can't remember what school, but a pretty prominent school for theology. And he works with some very large financial organization, guiding them on faith-based organizations and investments. So some of the bigger corporations are starting to look at that now. And I thought that was really, really cool.
Yeah, that's something that about probably 2 to 3 years ago, more people have actively came to us asking for, in compared to in our general conversation. Obviously, we're not shying away anybody who isn't a believer or anything, but the conversation always comes up how do you care about investing? Do you have certain beliefs, whether it be on various different topics, not even just on a religious topic, that you want to make sure you stay away from? And something that just the general request that started to come up over the last few years, a lot more prominent, is, well, I'm a Christian, and so these are my values, and I want to invest in companies who are in agreement with that.
Right. So you said, see the difference is your motto. And I kind of want to lean into that because I think it's important to talk about the way in which you approach working with the clients that you work with from an advisory standpoint. And it's really education first for your clients. Walk me through what that actually means and how you build a portfolio and investment strategy around that education first component.
Yeah, so that actually leans right back into the see the difference, like you said, on even that general concept. So we really aren't, if you want to call it investment managers and advisors itself, we're more so designed to be financial planners. So usually our conversations are starting off getting to know everybody's situation as in detail as possible. And that goes down to where your legacy is, what it was like growing up, how finances were discussed growing up, your various challenges, where you want to go, where you like going on vacation, all those types of things that make up somebody's character and personality to help design a plan and at least a process and guide rails for moving forward so that it's as best lined up with them as a person, not just numbers on a page. So the portfolio is more structured around what their objectives end up coming out to be, not so much, well, here's your risk, how much do you want to stocks, bonds, etc. That's usually dialed down based off of the goals themselves. We then take the step back and say, okay, this is how we want to invest.
So let's talk about something that you brought up in terms of the questions that you ask. And I think this is really important. And it's the discussion or beliefs that people have around investing or money that comes from their childhood and what they grew up with. How much does that impact the investment decisions that they make? And we've got an audience of business owners, of entrepreneurs who are always taking risk and wanting to build or correct something. And a lot of times they're focused on building the business. They're not focused on making sure that their personal finances are actually set up. So how do you deal with that and help them get over built-in biases that they might have from childhood so they get to a place of really good financial management?
Yeah, so definitely a lot in that question there. So
break it down. We'll go in steps.
Yeah. So first off, the correlation between how they were raised and then how money was communicated in the household drives a lot whenever somebody grows up. And a lot of that actually comes down to how they treat their spouse and how communication is between their spouse, and that drives major impact in relationship. I mean, like the number one reason for divorce is because of financial reasons. So if the communication factor itself around money is usually a massive driver that we're trying to unpack when we first talk with somebody. Usually it's just more so bringing it to light, because most people, they just aren't even aware. Like they're like, well, everyone's absolute favorite quote from anybody. What does everyone else do? Like the amount of times we hear that a week, it's hilarious. Well, you're not trying to be average. You're trying to hit your goals. So if you're different, then you're different. Great. Usually there's a root as to why you handle things a certain way based off of how you were raised. And so it's breaking down, how is it that you were raised? And then what are your current goals? Can you achieve that on your current track? Or do we need to figure out how to change your behavior around and your mindset around money? So that's the starting point on the impact that it has for most people. It's very heavy for almost everybody. As far as getting over that hump for business owners, instead of just focus on growing the business and then neglecting their personal finances, it's very difficult on a advisor level. Just because it's not, most business owners, if they're getting advice from somebody, unless it's another fellow business owner and they actually have a track record of success, it is from what you would call a consultant or whoever. And they're like, usually the experience behind that is, well, they've never done this before. They've never been in my shoes before. So they're just telling me to do these things, and they really don't hold the weight in it. There's 3 partners here at our firm, myself, Eli, and Shane. All of us come from a different background, and all of us are involved in business. We have multiple businesses ourselves. So we do the boots on the ground stuff. We build the systems, we build the processes, we do the marketing, we do the HR work. We have an employee benefits company. So we know exactly what it's like dealing with all the insurances that you got to deal with, the headaches and regulations behind on that too. So it's just getting the concept that you are not the business separated. The business can be a tool for you on your personal finances, but the business itself is pretty much a separate entity. I mean, if you're an LLC, C Corp, anything registered, basically, legally, it is a separate entity. That is not you. So it's getting the concept that the business itself is not you. So you have to put the things in place and the people in place to allow it to work for you, not for you working for the business. And that is so different for everybody, but that's probably the biggest thing, is getting people to realize the distinction between that.
Well, that's something that I want to come back to, that you are not the business, and how you actually effectively separate all that. But we're going to come back to that. What I want to understand from your standpoint is what the difference between financial planning is and just having investment accounts. Like, what is the difference between the two? Because I know a lot of our business owners have investment accounts because, they're established business owners who have been operating successful businesses. They're looking to grow and make more and create more profits. But how do you decide, or is there a time in which you should move from just having accounts to financial planning? Should you start with financial planning and then have accounts? Like, how should it work?
Yeah. So all of this is my personal belief. So obviously it can be different from anyone else you might interview, but our personal belief is you have to start with a plan first. Because if you don't have the vision, the goals, should know what it is you're trying to accomplish, you can't work backwards to know what you have to put into those accounts. So usually it's start with the plan to then know what needs done to achieve the goals. As far as the difference, so we run into people all the time where we talk about, like, this is just like out in public, question introductions, whatever might come up. And one of the number one things we always ask is, hey, do you have an actual retirement plan? And they say, oh yeah, I have a 401k at work, so forth. I'm like, that's not a plan. Your paper says it's a plan when you get your statement, but by definition, it's not an actual plan. That's an account. So you don't know, like, what's the account doing for you besides just growing and you eventually use it. A plan has a purpose, or a plan outlines the purpose. The account fulfills the purpose. So that's usually like that's how we would explain the key difference between the two. Most commonly, advisors are actually here yesterday. I was on a call, and they were going through the general concepts that are out there in terms of, like, it's about building advisory practices and so forth. And it was a good relation back to business, because think of like a Walmart. They're national. They are a generalist, basically. They don't specialize in anything. They just, here's a bunch of stuff. Now, yes, because of their size, they're able to bring prices down, which makes them more competitive, and like that's how they're growing. But on the financial services and advising sector, having a large national company keep trying to grow and expand their footprint doesn't allow them to specialize. They have to actually get more general. So most of the advisors that work for the national companies aren't getting a true, like, specialized service for their clients. Right. Whereas the independently owned financial companies like we are, they can choose what their niche is and they can go deep into that, and that's what they work with. And so now they're highly specialized and they can help in those situations. And for us, it's business owners. So that's the key difference. A lot of times I'm working with, like, say, a conglomerate versus an independent financial firm, whether it's us or somebody else. Mm-hmm. Usually we lean more towards at least work with an independent financial advisor, because they're not tied to incentives, extra bonuses, all that kind of stuff from their managers. That it would just be a production based thing through whatever company they're associated with then. So
with that in mind, tell me what the difference between, like, an asset manager would be and just somebody who is, or I should say an advisor versus an asset collector. What are the difference between the two?
So I would associate that more so with people who actually try and get to know why you have an account, where you want to go, and then they're actively having the conversation with you on why they are suggesting to have things invested a certain way to be achieving your goal. And it's all about you in those conversations, not all about like, well, hey, we can put the money here, we can do this, we can do this. So the one is, it's based around you rationale. The other one is based around where it's being invested, how it's being invested, and so forth. It's kind of a minor difference, but when you're in the situation, you'll know exactly what I'm talking about. It's a whole different experience for the client on the feeling. There was option number one for somebody who's just
Well, I think it's actually
advise,
very interesting that
but really don't share the result.
I think what's interesting, the way in which you put it, that when you're dealing with a larger advisor, there's incentives for them to sell certain products. And that is a thing. So finding somebody who has a niche, who can service your needs, is really important to make sure you're building the right financial plan. And when you're going in and you're actually meeting with someone, so say it's one of the business owners or entrepreneurs that is our audience, what questions should they be asking to make sure that they're working with an advisor that's going to be able to meet their needs?
Most important questions is going to be, what's the exit strategy? Do you have accurate books?
Now, are these the questions that is the... Okay. Got you. What do you want your income? But what should the client be asking you? Like if you had the perfect scenario, what should the client be coming in and asking you?
That's a great question, because usually that's not how it works. So that's what I really got to ponder on this.
Well, here's the good thing, and Mia,
a great starting point question would be, I want to be able to know how much I need to retire. How many different ways can I do it? And try and just gauge, like if this is for like more like a vetting of an advisor you're sitting with, try and just gauge how much they're aware of different strategies. And if they never bring up like if all they bring up is, well, you can sell the business and then you can take that, you can invest it, or you can have that produce income. Like if that's all they say, they're not really talking about the true different strategies. You have seller finance when you sell the business. So are you doing lump sum? Are you like the concept of selling the business? Is it a lump sum at one time? Is it seller finance? I think the last stat, like 87% of small businesses when they sell, it's seller finance. Like, so they should be bringing up and making sure you're aware of, okay, well, if you do intend to sell the business, you should probably plan on the fact that you're not just going to get a check at the end, because more than the vast majority don't have that happen. So unless you're special in whatever your circumstance is, we need to plan that you're not going to get a lump sum check. So it's income strategy. It's talking about how long do we want to have income for? And basically, if all they say is a couple of sentences and they really don't get into any actual strategies or anything, because the question was, how am I able to retire? Like, I want to be able to know how to retire with my strategies. If they can't name at least a handful based off of what they're aware in your situation already, then it may be just they don't quite have the experience working with a business owner who is actually looking to be using their business to retire.
So let's say we'll use a real-time case. We've got a business owner who's had a business for 15 years and they're in their early 60s and they're looking to exit and retire. What are some of the strategies you would suggest that they employ to be able to do it seamlessly? Yeah.
So we almost always, in that circumstance, we are hiring a tax planner to work along with us. If, for example, and this isn't tax advice, from my understanding, with the current tax laws, if you have a business and you change it to a C Corp, after 5 years, you can actually sell the business for up to $10 million and you pay $0 of taxes. So that's just the key strategy where if you're planning ahead of time, okay, well, now we might know that could be a variable for you. From there, that helps us dial in what it is we have potentially to work with, but we're also looking at it as, this is how much income you said you wanted. With your current assets, what can be produced? What's the gap to know what we have to sell the business for? And then from there, it's, well, can we get a business valuation? Do we think we're going to be able to sell it for that? If the answer is yes, then it just starts getting into more conversation of, okay, well, how do we start getting the structuring and the processes and systems in place to make that transition more seamless? And then that's when we start working with our various other professionals to improve the functionality in the business to get maximum dollar.
So can you walk us through an example of a business owner that you've worked with recently in the past that has sold a business that you helped them maximize the value in the marketplace?
Yeah, so there's one that they haven't sold yet, but we're currently working with them. We've been working with them for 2 years now. When they first came to us, they had a business valuation done from an accountant that actually did not end up being accurate. They did not have any systems or anything in place to allow for somebody to purchase the business. So it's a form of mechanic for marine equipment. Just in case somebody saw this, it's from around here. We're a very rural community, so I don't want to give any more details than that on it. But
okay,
now that we are getting into the conversations of, okay, well, now you have to make sure your people are trained to do the stuff that you do. So then when a new owner does come in, it can help that transition. And we started about 2 years ago working on this, getting these systems in place. We actually just had our meeting last month, and actually it might have been 3 weeks ago. That's been quick. And they said they now have a buyer currently interested, and the conversations are moving forward. Whereas prior to that, they tried selling it multiple times, but they couldn't get anywhere because they couldn't really trust the books. The people looking to buy it were like, well, you guys are the ones who are like, know how this operates. Your employees can't fix this thing, but you can, and you're going to be retiring on me. And so now that they've started getting that training and implementation in place, they're probably about 6 months to a year, like in my opinion, to be where we can basically go on the open market and try to start selling versus them privately sourcing.
So this business owner went from not having a buyer, to having a buyer. What key systems did they put in place that made the buyer look at it and go, oh, wait, this is a company that we can acquire because it can operate without the owner being involved?
So this one wasn't quite so much for without the owner being involved. It's just the business can run without the owner. Like there's still the management structure behind that.
Gotcha.
So the first thing was making sure all the mechanics were cross-trained. That wasn't a thing before. The wife did all of the ordering and inventory for the sales department. So they weren't trained to know and pricing. So no one was trained how to do that portion of it. So that was offset to their management staff, and now basically what you would call their CFO.
Okay.
So their CFO now knows how to do the books on that standpoint, as well as help with ordering and pricing. So that's been the two biggest drivers, is just the ability to perform the service, and then the how to actually handle the sales and pricing aspect of things.
So it sounds like to me that some of the key SOPs that the business had to create were trainings, SOPs, sales SOPs, bookkeeping SOPs, how to manage inventory, how to manage ordering. And for that particular business, that's the systems being in place is what made them much more valuable in the marketplace.
Yeah, definitely.
So let's dive a little bit deeper into that, because something that you said earlier on was that you, as the business owner, you are not the business. The business is the business, and it's its own separate entity. How do you help business owners shift the mentality where they can get to a point where they can remove themselves from the business so the business does function without them?
Great question. So it's very situational. Usually it comes down to if the business owner is actually willing or looking to do that. So there is no such, I'm going to pretty much just say there is almost no such thing as actually being passive as a business owner. You can do things to minimize how much time you need to spend in the business, but you're still going to have to spend time there because your employees see that the owner is not involved. And then it's just culture related that things start going south from there. We can get you to a point where you're basically the culture builder and you're just there to help engage and interact and keep morale and motivation high within the workforce. And then you're basically just having meetings with your staff about the financials or any new projects you're coming up with and so forth. But you're putting leads in place where they're taking care of all the work. You're just making the logical decisions and instead of doing the physical work yourself. That's really where we're trying to get the business owners to. So then that way they're thinking 10 years in the future, not 1 year in the future or the next paycheck. So then that way the business has a future to go with it, not if you leave then the business starts to collapse. So it starts at the ground floor of what are your intentions?
I think you have the name of your book, The Culture Builder. And I love the concept of you as a business owner need to get to the point where you're overseeing each thing and component of the business and working on the business, but not in the business as the culture builder. So it doesn't rely on you. That's brilliant. I love that. So so we've got business owners who are deep into their business 5-10 years. They're not at the point where they are looking to retire or sell the business, but they're at the point where they want to have more financial certainty. How do you balance the planning for your business and its financials and your personal financials?
Yeah, so it all goes back to having a plan. If you have your personal financial plan outlined, you know what it is you need to personally be able to bring home. At that point, we look at, are you in that situation where your business, as of right now, from what you understand, can produce that? If it's a yes, then then the conversation is, okay, now we just need to see what factors in the business we can stabilize so you feel more secure on that aspect. Usually it does come down to, and I know all the business owners hate it when they hear me say this, just because they have everything on their plate as it is, but they need to know where their own personal household expenses are so that they know what it is they actually need. Business owners waste so much money in their personal finances in comparison to, I think, even the standard W-2 employee. And that's saying a lot because over 60% of the country is paycheck to paycheck. But it's because they're focused on where's the expenses on the business, not myself. Knowing where your expenses and the income that you're actually taking into your household, if you have a spouse working or something, is very important. So then that way you know what it is you have to personally work with. Once you know what you have to work with, then it's just okay, well, how do we increase it? Making money isn't hard. It's the managing of money that's hard. So it's just once we know the baseline, how do we get it higher and what systems have to go in place or what improvements or slight adjustments have to be made at the business level to make that happen.
So let's say I'm a business owner and I come to you and my business is buttoned up, but my personal finances are a mess and I don't have a plan. What are some of the key tips that you would give me to start managing my personal finances more effectively?
Yeah, so we don't really believe in budgets, but we believe in tracking. So the money is it sounds counterintuitive, but money is more psychological than actually like math. So we always start with giving a tracking template where you just record your expenses every single day for a month, 2 months, 3 months, or you work backwards and you see where you were at. And then just that itself usually gives people the realization like, yeah, that shouldn't be like that. And like they just recognize it then. And that's how the behavioral aspect starts being applied to it. Because once you're doing it repetitively and you know where your money is going, eventually you stop doing those bad habits unless it's by choice, not just out of habit or stress related or whatever it may be, because you know you're hurting yourself. So usually the starting point is just actually track your spending to know where it's going. And in a lot of things, it just fix itself.
The financial habits are really important that you bring those up because, I mean, up until maybe 5-6 years ago, I did not have good financial habits. And I'd make or earn a lot of money, but then I'd make an investment or I'd spend it. And not even on frivolous things. Well, ultimately it ends up being frivolous things when you're spending $5 a day on a coffee at Starbucks. That's a lot, ends up being a lot of money. But until you actually pay attention to your cash flow in a business, but also your cash flow in a personal sense, do you start to get a grip on your personal financials and your business financials. So I do believe that the psychology around money is really important, and paying attention to your money and how you're spending it is tantamount to success at achieving your financial goals.
Yeah, and that's not even on a personal level. It's also on the business too. So something we encourage business owners to do is, if say they have a partner, I'll start there. If they have a partner involved, have it a financial review meeting depending on your situation. It's either every week, every 2 weeks, every month, or every quarter. And break down the financial health of the business and just discuss, hey, where are we at financially on what improvements we're wanting to do, and like what's our next projects that we're wanting to invest in, and work. So then that way you have that constant health on your business and tracker. And that comes down to making sure your profit and losses are up to date as you go throughout the year. So you can see where you're actually at as you're making these decisions as the year goes on. And then that also allows you to sit down and say, hey, we have $50,000 in the bank account. We internally pretty much set a minimum of $40,000. So there's another $10,000 extra that's not earmarked that we don't have to put into the business. Hey, now we get to pay ourselves an extra $5,000 each in an owner draw. You wouldn't have known that if you didn't sit down and talk about it. If money's in the bank account, it's eventually going to get spent. You're going to log in. You're going to see, hey, I got 50 grand in the account. Oh, I can buy that $10,000 machine. So, but it might have been, like you said, technically that's frivolous because you really didn't need it. It's just in this situation, you didn't have that pain point of handing the cash over to make that purchase.
Yep. I've suffered through it myself. And it actually kind of leads into my next question, where I want you to talk about the financial cycles that people and business owners have in their lives, because I do feel like at different points in my life and in my career in different ages, I've had very different focuses on the management of my capital, how I'm running my business, what profitability looks like, what are some of the key financial stepping points in most of your clients' lives.
Probably just, usually it's the realization that they did not see everything that was happening with their finances, like mainly what they were spending their stuff on. From there, it usually goes into a form of, okay, now I want to make a correction, and they have a few months of good. But then they start falling back into the cycle. If they're not in like our actual advising, whatever program, I guess I would call it, like if they're just, they heard the concepts, they started with it, they realized they're gung-ho, they want to move forward with it, not working with us on an accountability standpoint, then they kind of start dropping off again. But then we have our next meeting, and then they get remotivated and start going again. So usually the first, there's going to be 2 or 3 bumps of, hey, motivated, and then not. Motivated, then not. Once you get over that third hump, it feels like that's when everything just starts taking off. From there, the next step is running into, and actually there's a concept whenever it comes to revenue on where your pain points are as a business owner. Usually it's at 300,000. Your bottleneck is you're doing everything and you're being everything to everybody. And then it's $1 million. And at $1 million, that's where, well, I have a lack of capital. I'm not really making what I want to make, but I have some people in place, but I need to make another big investment to get me to the next level. And then once you get into like your between 5 and 10 million, depending on the industry, then it's more so the headaches that come along with well, I don't have enough time to get all of this done because I have too many projects and the ever expanding team. So that's where your delegation and all that comes in, and your executive assistants and so forth. So that's where your next, I guess if you want to call it, cycles come in, because if somebody stops at 300 point, then they're just going to be running on the hamster wheel. Same thing at $1 million, and then so forth. So those are usually the next stages that come in place once people have their standard understanding.
So what you see in terms of the business cycles is the businesses that are doing 300,000 that the owner is really heavily involved. When you graduate to the $1 million range, you're doing more, you have employees, but you need investment capital to expand. And then when you get to that $10 to $25 million mark, which let's call that the third cycle, that's really when you start to have so much on your plate and so much opportunity that delegation is going to be key. And you have to be a different person in each one of those cycles to take your business to the next level.
Correct. Yeah, totally. And that's where the mindset and how you handle business and everything comes in. And that's why the cycle is a cycle, because if you don't adapt and learn, you're going to revert to the previous one.
That's why the cycle is a cycle. I love it. That's great. So let's pivot a little bit and talk about another component, which is really important to your financial planning. And that's insurance. As a business owner, because you're talking to an audience of entrepreneurs and business owners, what type of insurances are key to making sure that our business and our personal lives are secure?
So pretty much every insurance is assigned. I am definitely not a fan of being overinsured. I think insurance is one of those things that everybody hates paying for, but it does serve a purpose. Just in the last month, 2 months, we've had 3 death benefit claims for businesses that we work with for their group life. So that we had to go through that whole process. Each of those businesses are going to run into a problem because that employee is no longer there and they're instrumental to the success of that business. So in terms of I'm going to say protection standpoint, obviously your general liability, any E&O, workers' comp, all of that stuff. I'm really not going to talk a lot on that because that's not really where we shine, and there's specialists for that based off your industry. In terms of the insurances that you need to start thinking of when you're getting to say the 300, 400, 500,000 in revenue is what you're going to use for retention of employees. The smaller businesses really have to start offering employee benefits now to compete with the large. It doesn't have to be expensive. Group life, disability, accident, what else is there? Vision, dental, so forth. You can get really reasonable rates as an employer if you're fully paying for it. That's the key difference. A lot of businesses will say, well, I want to pay for 50% or 75%. The insured and the insurance companies actually give a pricing discount if the employer is just writing the check every single month, because they know that they're going to get paid. It's not going to drop off. An employee doesn't leave, or an employee doesn't decide, hey, I no longer want to pay for this just randomly, and they don't have the administrative headaches involved with that. So they actually give discount for employers to just write the check. So that really helps. Health insurance is definitely a very big one, but there's a lot of things going on in that space right now that is hyper situational. For example, ICRA's, QSERA's, doing general group health. That's all various things, and I recommend talking to your employee benefit specialist that you're using on the topics of, say, QSERA and ICRA, where that might work in your business. Latest report, ICRAs are expected to increase by number of people participating over 250% in 2025. So that's a very big increase in what's being expected in the industry using that tool. Don't have time to get into
Walk us through that tool. Walk us through that tool briefly, because I'm not familiar with it.
Yeah. So basically what it is, it's an individual health reimbursement account, basically. What it can be used for is health insurance premiums. So say you're currently paying $1,000 a month per employee for your health insurance, and you're just fully covering them. Group health insurance is almost always more expensive than coverage on the marketplace for individual coverage. So what a lot of employers are doing, if they're over 50 employees especially, they're just dropping the group health. They're not getting their 20% renewal rates and everything every year anymore. And they're just saying to the employee, hey, I will cover $1,000 a month for you to go onto the individual marketplace. You get to choose whatever plan you want. If you want it where it's fully paid for by me, great. If you want to pay for a premium plan, you can do that too. And that can be set up multiple ways. A lot of people, they then have administrative team where the employees have to give them proof of payment, and then they direct deposit it into their bank account or whatever it might be, which HRAs, because they're a reimbursement, is tax deductible to the employer, but it's tax free to the employee. Whereas health insurance, it's pre-tax to the employee, not tax free. So that's another key difference for factoring that stuff in too.
So this is fascinating because what you're saying is you can use benefits and health insurance as an employee retention tool when you're a smaller business. And there's products out there today that make it economical and affordable for you as the employer.
Yeah, correct. Especially like those ICRAs and QSERAs, you set what you are willing to pay. So if you're willing to pay $100 a month, you can do that.
So before we get into our fun rapid fire section, I do have one more question, and I would love for this to be the takeaway because I think it's important for our audience to hear. If you've got a business owner who's looking to put a plan in place to take control of their finances, what would you recommend their first steps be to do so?
Compile your overall documents. Where's all of your accounts? How much is in every single account? What is your assets? Like, what's the value of all your equipment? Compiling your total portfolio, because a portfolio isn't just your investments in like the stock market. It's also what are the assets that you own. Compiling that, seeing what that is the number one thing to start with, because from there, that's when you're taking it to a financial planner, and now they have the full picture on the physical sense.
Gotcha. That is extremely helpful. Now we're going to go into our rapid fire section. I will throw out a question. You're going to give me a quick answer. You ready?
Okay, ready.
Coffee or tea?
Iced tea. Yeah, not a fan of hot tea. I'll take iced tea.
Awesome. It is a zombie apocalypse and you have to get out of your home and protect your family. What would be your weapon of choice to take with you?
I don't know how I can answer that because the analytical side of me comes out and it's like, well, can they actually be killed?
All right. So that might have been that was a bad question for you. Most people have an answer to that. Mine would be a flamethrower, but I understand. So do you have a favorite book that you think our audience should read, maybe about financial management or business management?
Yeah, on a business side, a book called Principles by Ray Dalio. It is a very dense book. I'm going to preface that, but great material in there on the structuring of your business, how to be taking it to the next levels, and so forth.
Awesome. I love it. Do you have a coach or a mentor?
Yeah. So I have one for multiple different things. Like, on a financial standpoint, I have one guy that I always go and I bounce ideas off of. Obviously, nobody can know everything. So you got to have a team around you. I have an attorney that I talk to, CPAs I talk to, so forth for the various situations and try and compile everything to make informed decisions. And then how to then grow on a emotional standpoint and everything else as well.
Awesome. Give us 3 money saving techniques for 2025.
Tracking, pay with cash. Like, so the tracking, like we were talking about, like just have a tracker, write down your expenses and everything that you did on the days that you did it. Using cash. If you go and you say, hey, I have $200 this week for groceries, using cash over credit cards, that is a very big difference. Number 3, reprice out your insurance. But make sure you have adequate coverage.
I love it. And our last question, who are 2 people in your life who have helped you get to the level of success that you've achieved in your business today?
My wife, and then I'm going to actually say 3 because my 2 other business partners.
Awesome. Reese Stiller, thank you for joining us on 0 to 100. Please tell everyone where they can reach you.
Yeah, so they can reach us through Facebook, just Kingdom Guard Financial Group, our website, kingdomguardfg.com. call in the office. That's another way. We're pretty easy to reach. Just got to look us up. We're all over Google.
Awesome. Reese, it was great to have you. Thank you.
Yeah, thank you, Jared. I appreciate it.
Thanks for tuning in to 0 to 100 podcast. We hope you feel inspired and ready to accelerate your business. Remember, your journey to success starts with a single step. Keep learning, keep growing, and keep striving for greatness. For more resources and show notes, visit jaredguyrandolph.com. We'll see you next time.